high-level summary of things is that there are what we've called a troubling triad of macro factors that are impacting Asian markets. These are not unique to Asia, but they are particularly acute, I think. And that's, of course, it's interest rates, it's growth, and it's the dollar. Just to slightly unpack that, what we're seeing, of course, is that interest rates led by the Fed are increasing significantly because of inflation pressure. This is all very well known. What I think is useful to emphasize, however, is just how much expectations have shifted. At the beginning of this year, the market was pricing 3 Fed hikes from basically 0% to 75 basis points. Now the market's pricing, and our view is 15, up to a terminal rate of about 4.6%. So that's a huge shift in terms of the interest rate environment and therefore the discount rate. And that, of course, explains why overall level of markets has gone down, as well as the significant shift from growth to value, because the longer duration part of the market, the more growthy part of the market, tends to come under pressure when rates rise. So that's number one. Number two, of course, this is coming at a time when growth is declining. And so the intersection between rates and growth is a particularly toxic combination for equity markets, which is why we've seen global equity markets, including Asia, sell off. And then on top of that, you've got a very, very strong dollar, as the expectations around U.S. short rates have outstripped those of elsewhere in the world. So as the gap between U.S. rates and the rest of the world increases, that's contributed to dollar strength. And it's very clear, if you look at past 10 to 15 years, that a strong dollar is associated in the short term with weaker equity markets. So it's the combination of those three things which is really impacting the region. Just very briefly, the offsets, however, are that number one, prices have come down a lot. Number two, valuations have also compressed very significantly from 18 times earnings for the region to about 11.5 times right now. And then number three, foreign investors have sold a lot. So there's been some compensatory action which discounts some of the fundamental challenges. But our view, to wrap it all up, is that we are still quite cautious in the near term. Think that there's some potential for markets to recover on a one-year view, but certainly in the near term, it looks like we're still in a bumpy time.
Timothy, really quickly on that, are you concerned with the run high that we have been seeing in real yields at the same time and how that plays into the valuation perspective?
Absolutely. In fact, David Costin, our U.S. strategist, he just took his S&P target for the end of the year down from 4,300 to 3,600 on the S&P. And that's really a function purely of changing our expected or calculated fair value for the S&P from 18 times earnings down to 15 times. And that's really driven by the change in real rates. We have a quite a useful chart in the recent report that we published, which shows a very close linkage between S&P valuation and the level of real rates. If you flip them over and invert them, the two are pretty much moving in tandem.